Hi, everyone. Welcome to Retire with Style. I'm Wade, and I'm joined by Alex, and today as well by Bob French. And we're going to be talking about inflation, but it's been a long time since I've been on the show. Alex, I was on summer vacation, and Alex took care of things and had a great series on reading the ADV of a financial planning firm. And I actually learned a lot
like reading
listening
the
to those
phone
episodes.
book.
Yeah, it was. I could tell Alex was having to be patient to get through every single part of the ADV.
Oh,
But
come
it was
on,
definitely
man.
a very interesting series of episodes. I learned a lot.
Did you
It's
really? Or are you
definitely
just saying
useful.
that?
I've referred people to it already. So
Right. Yeah.
Well, I mean, the reality is that a lot of folks just want to know, okay, what am I getting into when using an advisor? And I don't think they realize that there's actually a codified pamphlet, that brochure that advisors have to give to folks to make them more informed. And it's one of those things that the realization is, I don't think anyone really reads this, and they actually should. And so we just forced the issue a little bit, and now it's in the archives. So it's one of those things. Now, Wade, I do say, I do think, like, the folks listening in, they were like, oh, okay, Alex and Wade, and, now it's just Alex. And I wonder how many of them thought to themselves, man, why couldn't it just be just Wade and Alex go on vacation? Everyone felt
vacation too. But the summer is over, so no more vacations. And we are back for the fall season. This is really the season premiere in that regard. And of course, we've got Bob French for those key ratings in the demos and the
that's right.
Nielsen ratings and everything else with sweeps month. So it's September sweeps. We've got the heavy hitters, and we're all here.
Bob, do you see what's going on? Do you see? Wait. Wade is flexing his comedic muscle. Oh my goodness!
It is. It's
that was nice,
I'm not
Wade.
saying anything. I'm just saying, we can look at the comments we get here.
It's sweeps week.
Yes.
Hey, by the way, I binged on One Piece.
Oh, the new live action one?
Yeah. Well, the anime is great. It's like one of the all-time greats. And my kids got me into that. And then they had the live action, so I had to see it. It's pretty good for those of you scoring at home.
Okay, yeah, I have yet to watch any live action versions because they had Cowboy Bebop as well.
Yeah, they kind of run away from those, the kids. But I don't know. I'm not a snob, live action snob. I thought it was pretty good, actually.
But you're making a pop culture reference about something that happened since the 1970s. I'm impressed, and that's going to come up in today's episode, being on inflation.
Wow.
Alex with all his references to the 1970s.
Yeah. No, not only was it a segue, but he took a dig at me and everything. Oh my goodness. This guy is like came out swinging.
But other than the last couple of years, Alex is the only one who has inflation in his living memory. So he's going to have to tell us young people what it's all about.
Wade really has been resting here. He's saved this all up.
He's been like, let me call Alex. No, let me write it down and wait for the podcast. No, let me write this down and wait for the podcast. He's got a lot of emails that are like, note to self. All right, sorry, Wade. You had a great transition. Go on. We're never making. This is going to be like 10 episodes on inflation.
No, we're going to talk about inflation, and that is something that for many people we haven't really seen much of it since the early to mid 1980s until the last couple of years. We were reintroduced to the idea of inflation. But Bob is putting together a series of discussions that he's going to be doing with the retirement researcher community, with McLean Asset Management. And so we thought it'd be great to have Bob on to provide us a preview of all that and to have a little arc. It's going to be a few episodes. We never know in advance how many exactly, but we're going to get started today to talking about inflation and the role and the importance of inflation on financial planning, and of course with a particular focus on retirement income as well. But today partly will be for setting the stage of what inflation is, how it's measured, some of the different types of CPI indices. We'll have a little quiz on the CPI-U and CPI-W and CPI-E and so forth, and just really get a sense of what inflation's looked like historically as well. So welcome back to the show, Bob. We've not had you in a while. It's great to have you here
It's
again.
been a little while. Thank you. So, yeah, as Wade just said, well, actually, when this comes out tomorrow, we'll be having in the Retirement Researcher Academy our workshop on managing inflation in your retirement plan. But we wanted to kind of talk about this here because, well, it's a really big topic. And it's been, as Wade just said, top of mind in a way that it has not been for the past 30, maybe even 40 years. So it's something that people are starting to really kind of grapple with, and it's something, Wade, you actually called this out a little while back in your 7 risks of retirement planning. This is one of those big 7 risks. So we need to be able to deal with it and work with it effectively because it is a fact of life. And what we want to do is kind of start with, what is inflation? Why does it exist? What does it even mean? And how do we kind of understand what it might look like going forward? So, I think everyone kind of gets inflation to a certain degree. It's prices are going up. That's inflation. And it's actually not a horrible definition of it. It's, the cost of goods and services is going up. You need to give someone more money for the same amount of stuff that you had to give them less money for in the past. Now, Wade, with your economics PhD, I'm sure you can give a more precise definition. But yeah, that's kind of right. I mean, Wade?
No, you got it. Yeah, it's just the change in the price level over time. And we generally just think of inflation as being a positive number, that prices are increasing over time. That doesn't have to be the case. You can have deflation, which can be very damaging to an economy as well, as we'll talk about a little bit. But deflation would be the price level is decreasing over time. Mm-hmm. We don't see as much of that, although Japan would be an example of a country that has experienced deflation in recent history. In U.S. history, to see deflation, it goes back more to before the Federal Reserve discovered monetary policy, and it was more the gold supply in the world and so forth determined the price levels and all that sort of thing. But that's pretty much what inflation is. It doesn't really have to get any more technical.
No.
So could it get less technical? Yesterday's price is not today's price.
That's right. And the other one I want to call out there is, a lot of the times people talk about shrinkflation, where instead of changing prices, they change, the volume of something. Your candy bars get smaller. That's also a form of inflation. And actually, we'll talk about this later, but it is picked up in the more formal measures. The CPI.
Bob, does that happen when you go in the water?
It's shrinkage.
Sorry,
that's a 1990s cultural reference.
That's right.
I'm getting better. Wade.
We're gonna settle. Like, Alex, when did you graduate high school? That's about the time period we're gonna settle on here, I think.
1990.
Okay. Well, no, I think Seinfeld was a little late there, so you got to pull it back.
Premiered about that time.
But one of the other things to call out: inflation is a massively political topic, and it's been massively political since money has existed. You hear about like ancient kings and through the Middle Ages debasing their currency or debasing their coinage. That was inflation. There's a lot of other stuff going on there, but that was inflation. As we've gotten into more kind of a debt-based economy, it's even more important. Wade, you're from the Midwest, so you probably learned all about this, but the Cross of Gold speech, that whole time period, William Jennings Bryan and all that type of stuff, that was explicitly about inflation. That was the big political issue of the time. How do you deal with that? It was around, being on the gold standard, whether that was a good or a bad thing, but that was almost exclusively. There was some trade stuff going on there with it as well, but that was about inflation. That was about, how do we want to grow the money supply? And those fights,
the silver,
exactly, bimetallism. Um, so, and that stuff continues on to today. And that's something we're not going to deal with too much, because you can tell a story on both sides, and all we're going to do is make one side angry, or make both sides angry, most likely, if we start getting into that. So we're gonna punt and just pretend we don't need to talk about it. So
Wade, he said punt. That's not the word we said. That's not. He even has it here. Bob likes to write meticulous notes, and he has lampshade interlude. He literally called it that. Lampshade interlude.
Yeah, I was waiting for you to do this part, Alex. So
no, I'll stop because now you're playing me.
Yeah, and
Like a
I've
little
heard of
puppet.
gaslighting, but not lampshading before Bob introduced this term to us the other day.
Yeah, Bob's
But
like
it's too-
Geppetto.
that's right.
But then I noticed in the notes, Bob does bring it up again later. Maybe it's worth just getting the little.
As I was
interlude out of
putting
the way
those
now.
notes
It's-
together, I was figuring we would drift back in there, but
And
Talking about
it's
the
just,
political stuff.
it's just a reference to supply and demand. Like,
yeah,
if supply and demand determines prices, and part of the political argument is what is at work. Is it because of the increasing demand for goods and services generated by government fiscal policy being like very expansionary, or is it because of a decreasing supply of goods and services because of all the different bottlenecks and so forth that were happening with the pandemic and its aftermath? And ultimately, it's going to be a combination of factors. It's not just one or the other.
Mm-hmm.
And there it's said, now we can lampshade it using Bob's
well, that's
terminology
probably going
and
a little
focus
too
on-
much depth to be true lampshading here, Wade. So, but no, we can actually talk about that now. I mean, this is as good a place as any. So
I'll say it like this, because if I tell my buddies, "Hey, listen to this podcast. We're talking about inflation." A lot of them are going to be like, they're going to be thinking, because it's so politicized, they're going to be thinking in those terms. What's your general argument, both of you, when someone sort of points to inflation and then draws a line to the current administration? It could be a conservative administration. It could be more of a liberal. It could be a Republican. It could be a Democrat. What do you usually say without the simple answer of, "Oh, it's too many variables. Who can tell?" Or it could be that could be the answer. But when you say it like that, the reality is, I think our listeners kind of blow it off like, "Oh, he doesn't want to deal with it." You know what I mean? I think there's always that component to it. And so
Wait, do you want to take first swing, or do you want me to?
And don't worry, Wade. No one's listening.
Go first. Guests go first.
Let's go first. Look at this guy.
Sure. So the first thing I'll say, and we'll touch on this, at some point here, but inflation is back around its historical average. The past year-over-year inflation up to this point, it's about 3%. The historical average is about 2.95% per year. So that's about as average as it gets. If we're looking at, the big numbers that we saw, basically coming out of the pandemic, it was 2021 and 2022 where we had really big inflation. I'd say that there were
7% range. Right?
Yeah, the big numbers. And especially if you're looking at kind of intra-year type of inflation instead of using kind of January to December. If you look, I forget exactly which ones it was, but there were some real big numbers in there. What Wade was talking about is absolutely right. There were two sides going on here. So, during the pandemic, we had all of those stimulus programs. The government was actively throwing money at the economy. They were just dumping money into people's hands. And, during the height of the pandemic, we weren't really spending it. But then once we started coming out, we started spending a lot. People didn't save that money for the long term. They went out and did stuff, which was the entire point of those stimulus programs. So that's one side of the equation, pushing up price levels because there was just more money in the economy. The other side was production. There was fewer goods and services available. People, they weren't working during the pandemic as much. Supply chains got screwed up. It was more difficult to transport stuff. So there was less stuff to buy. So we had a situation where there was more money chasing fewer goods. Well, as Wade said, that's supply and demand. You're going to need to give someone more money to get the same amount of goods and services. And the political fight is going to be which side dominated, which side, or not dominated, that's the wrong word, which side had a bigger impact. And then how does that move forward from today? It doesn't look like we're going to have really big inflation anytime soon. And we'll talk about how we have again, is too strong of a word, but, have some inkling of what inflation might look like going forward, a little bit. But the market is saying inflation is going to be actually below average for the foreseeable future. That can always change. That will always change, but it might change in either direction.
Yeah, that's the market's estimate right now.
No, I think you covered that quite well. Yeah, it's at the end of the day, there's many different factors at work, and all this is part of what's going on. And we had gotten used to very low inflation going back to like 2010 through the pandemic, where we were averaging even under 2% a year. And so when I wrote the first edition of the Retirement Planning Guidebook, I was talking about adjusting numbers into their real purchasing power when you're doing your budgeting. And it hardly made a difference if the inflation rate's like 1.3% or 1.9%.
Yeah.
But then we got hit with the 2020 and 2021 with significantly higher inflation. And then suddenly it does make a big difference, because if you spend $100,000, say, just to make up a number, in 2018, the purchasing power to be able to do that now could be, $115,000 or more, just because of those big inflation numbers that we experienced. So it becomes a lot more important to think about purchasing power and making sure that you're adjusting for the impacts of inflation now that we have a couple of years of high inflation numbers in there. But as you're saying, now it looks like inflation is coming back under control and is more in line right now with historical averages. But as we'll talk about as well, when we look at what the market provides to us to understand what future inflation might be, the market is not expecting that historical average inflation, even below historical averages, somewhere more in the ballpark of 2 to 2.5% over the long term.
Yeah.
And we'll talk about where that comes from. But yeah, that's really where we are today. But we don't want to skip the whole definition of, I mentioned the CPIU and so forth. And so let's make sure we cover some of that.
Bureau of Labor Statistics stuff. So, but Alex, I cut you off there as well. I'm sorry.
No. Effectively, I was going to say that when you said the market's not telling you about, the market's not signaling inflation, remember, that's just the current estimate of what's happening right now of all the players. Random information will come in, and that's definitely going to change the estimate. But as of right now, everything that is known, this is everyone's best guess.
Yeah. No, I mean, anytime we talk about market estimates, basically the only number it will not be is whatever the market is currently estimating. But that's kind of that's the center line. We don't know if it's going to be too high or too low, or the number will go up or go down.
That's the life we chose.
That's right. So,
but before
CPU, let's have gone. Sorry, Wade.
And also just like the idea of inflation in general, that actually, what is a good inflation rate for the economy? I guess would be a way to frame that. We don't necessarily want the inflation rate to be zero, right? There
the balance. Yeah, that's a good point. The balance between inflation and deflation.
Yeah, I mean, I think asking that is one of those loaded questions in economics. But it's above zero. A small handful of percent, I think, is probably a fair way of saying it. I don't think too many people would disagree with that. But it's really about finding that Goldilocks zone. Obviously, we don't want massive inflation. If we had 10% inflation every year, that's not a good thing. But deflation is really, really bad, as you said, Wade. I mean, what we want to be doing is thinking about people's incentives to save. So if we are in a deflationary environment where prices are coming down through time, what that ends up doing is people start hoarding their money effectively. They don't spend. They want to wait as long as they possibly can to make a purchase because it will be cheaper at some point in the future. And that's not good. We need people to go out there and spend their money. On the other hand,
it hurts business profit too, because
exactly.
they have to produce the goods, and then when they can finally sell them, they are selling them at a lower price.
Yeah.
So deflation is really harmful. And so economists and central banks and so forth want to have some positive inflation just to make sure there's a barrier so that you don't slide into the deflation side. And when I was going through grad school, a lot of the conversation was around inflation targeting. And it seemed at the time like many central banks were either explicitly or implicitly targeting about a 2% inflation rate, which is what the US in the recent past, 2021, 2022 aside, had been in the range of, like, not over 2%. They wanted to keep it under 2%, but close to 2%. And that just can provide more flexibility as well, not just to avoid deflation, but we know workers don't like to have wage cuts. But if you keep someone's nominal wage, their wage the same, and inflation is 2%, that's a 2% real wage cut. And workers may not complain about a real wage cut, but they definitely complain about a nominal wage cut. And so having some inflation just provides some flexibility in the economy to reduce real prices or real wages in a manner.
So you're saying, Wade,
more difficult.
So you're saying there's a deep state that's controlling the underlying salaries of everyone through this edifice of inflation. Is that what you're implying there, Wade?
Just that it creates flexibility for capitalists to cut people's wages without those workers realizing.
So is that a yes?
Something like that.
On a different note, we can turn this in a different way. Anyone with a big loan should like inflation because the amount they have to pay on that loan, assuming it's a fixed loan, goes down every time inflation goes up. Speaking of the Cross of Gold speech, that's what that argument was about. Farmers who borrowed a ton of money to buy their farm or do whatever they needed, they wanted inflation because the value of that loan went down. The bankers didn't want inflation because the value of their financial asset went down with inflation.
Well, Bob, I whenever you say Cross of Gold, I think of a Neil Young song. I think about Heart of Gold in my head. But not everyone is going to know what Cross of Gold is, and neither do I. Frankly, I don't know the speech that he gave. You want to give a quick 30 seconds, maybe?
You shall not crucify mankind upon a cross of gold.
Well,
it
was only 35 minutes. Wait, you probably know the whole thing.
It was the best of times. It was the worst.
But no, in the late 1890s, in the early 1890s, there was a significant depression, and part of it was based on the gold standard, and the supply of gold was not keeping up with the demand for gold. So it was a deflationary environment, and that hurts at the time farmers who were needing to borrow to get what they need to farm. And then if there's deflation, like you said, then they're going to be selling their goods, their products at a lower price. So they wanted easier credit, an easier monetary supply. And so that's where the whole conversation around silver came into play. And then William Jennings Bryan was the presidential candidate in the 1896 election that really took up that kind of populist cause of wanting more expansionary monetary policy, and really saying it was this idea of like Wall Street versus the real business people who are doing the real production of goods and services in the economy, and not wanting to benefit Wall Street at the expense of the farmer and the Main Street business person. So not wanting to crucify mankind upon a cross of gold. That's where the line comes from, 1896.
Got you. Well, I am glad that we no longer have that problem between Wall Street and Main Street. I'm glad we resolved that 130 years later.
Yeah. Yeah, it's amazing how we solve all of these major political problems through
Yeah,
time.
I'm glad we're not revisiting that anymore. All right, thank you, Wade.
You're welcome, Alex.
I'm ready
But
for my
let's-
AP test.
That's right. Yeah, I was. Wade, you grew up in the Midwest. I guess that is a much bigger deal out there. So you. But
Honestly,
let's jump.
I don't think William Jennings Bryan has much play anymore in the of course. I don't think
Really?
people are talking about him.
Really?
From 1896.
I don't think the fact that I'm from the Midwest somehow gives me a stronger link.
Okay.
He was,
okay.
of course, also known for the Scopes Monkey trial. He was
That's right.
the
Oh, there we go. Don't worry, Bob. They're
The
creating a musical.
prosecuting-
You're gonna love it.
We'll be the only two in the audience here.
You're gonna love it.
But let's jump in. We've kind of gone all sorts of different ways here, but why don't we talk a little bit about how we actually measure inflation? So as Wade referred to, there's a whole bunch of different measures of inflation done by the Bureau of Labor Statistics, the CPI, and then there'll be some letter after it, but Consumer Price Index. So what the Department of Labor, Bureau of Labor Statistics will do is they'll go out, they'll create a basket of goods and services, just a bunch of stuff that a normal person in whatever category they're looking at would go out and buy in their day-to-day life. And then they figure out how much it costs. And then they track that through time, and they anchor it at some point and then say, well, this is now in 1981, it cost $100 to buy this stuff. In 1982, it was $103.7 to buy this stuff. And then they just track that through time. And that's how we measure inflation. The normal one, or the one that gets talked about a lot, is the CPIU, which is, urban. What's the official wording on this, Wade? It's
all urban consumers.
Yeah.
All urban consumers.
All urban consumers. And they have ones for wage earners and, different areas of the country. But one that's really important for us is the CPIE, which is the elderly urban folks. So they don't have farmers, since we've been talking about farmers a lot, apparently. But, urban wage earners, urban elderly, people over 62. And everyone, but the CPIU, kind of all urban people, is the normal.
And that's the one that the CPIU is what, if you hear CPI on a news report, that's what they're talking about. CPIW, just as a trivia note, that's what they use for Social Security. That's the CPIW is urban wage earners and clerical workers, which really makes no sense. Like, we are using a more limited supply of workers for Social Security benefits meant for retirees. But right, the CPIE, it's an experimental index. It doesn't have official status. It just adjusts the basket of goods and services more for what elderly people consume. And so there's more of a weight towards healthcare expenses, health insurance, and housing. And when those factors have a bigger weight, what we've seen historically is the CPIE index actually increases a little bit faster, at a faster clip than the CPIU index.
Though not by nearly as much as I anticipated before I actually looked at the numbers. It's actually a relatively small effect. It's been in place. They have data going back to 1983. And compared to the CPIU, again, that kind of headline inflation type of number, $1 in 1983, it would cost the same amount of goods you could buy for $1 in 1983. Using the CPIU up to today it came out to $3.13. If we're looking at the basket of goods from the CPIE, it was $3.33. So over the past, 40 years, we're talking about a difference of 20 cents on the dollar. So it's not massively different, as a lot of people probably would have guessed, as I would have guessed before I went in and looked at the numbers myself. The correlation is really high between the two.
Absolutely.
Yeah, I think part of that is, well, healthcare costs do rise faster than the overall inflation rate. But then in
Yep.
that elderly basket, there's a smaller weighting towards education expenses
Hmm.
and college tuition. And then that's another, for the general index,
Yep.
that's another factor that tends to grow faster than the CPI as well. So I think that might be part of the explanation there.
Yep.
Why the CPI, using the same numbers you mentioned, Bob, that implies for the CPIU since 1983, 2.85% is an average increase versus 3.01% for the
I
Yep.
CPIE.
I do think though, if you looked at the chart though, Bob, in 2018 around that time, there was a significant spike in the CPIE.
Hmm.
Yeah, I think it was
Yeah.
like all the pickleball equipment that people were buying. What happened?
Yeah, it's pickleball.
I think that
purely
added
pickleball.
0.5%. I think that added 0.5% to the entire CPIE.
Yeah,
And
actually, I'd be
on the
kinda
backs of
curious.
my mother-in-law too. On the back of my mother-in-law, she's like supporting the whole damn index.
Yeah. Yeah, I was going into that healthcare stuff, all those pickleball injuries. So, but no, I mean, one of the interesting things is you can slice and dice the numbers, and there's really no difference in the sub periods. There are spikes, and they don't move exactly the same, but over any reasonable length of time, yeah, it's basically the same story. That might change in the future, obviously, especially, as well, as Wade called out, both healthcare and education change their inflation rates through time. Those are probably some of the biggest differences between the CPIU and the CPIE. Everyone buys groceries. Everyone, drives. Everyone, does a lot of the same things, but those are going to be the biggest differences in what those baskets look like. So,
Okay.
but yeah, I mean, it's pretty similar. And, as we've called out, if we take a look at what the historical numbers have looked like, the CPIU, we have data on that going all the way back to 26. The historical average was, just under 3. It was 2.95% on an annual basis. And, what we've been seeing, like we said at the beginning, this past year or so, it's about 3%. It's about average. It's about as close to average as anything in finance and economics gets. Well, we already talked about what happened in 2021 and 2022. So let's start talking a little bit, Wade, about, how do we think inflation will move going forward? How do we, we already called out, what we think will happen, but how do we get there? How do we know that?
Mm-hmm. Yeah, so we want to know expected inflation. What do people expect inflation to be in the future? And that used to be a really challenging question until 1997, when the United States government introduced Treasury Inflation Protected Securities, or TIPS, which provide a real rate of return plus whatever inflation ends up being. And then that allows us to see, we can look at Treasury yields on traditional Treasury bonds and Treasury notes and bills and so forth. And then we can look at the real interest rates on TIPS and look at the difference between them. And that suddenly gives us a pretty good estimate. There may be a few other factors at work, but overall, we have a pretty good sense of what the market is baked in as an inflation rate, because it's all about the supply and demand of people looking. If I believe inflation is going to be higher, I want to buy TIPS to benefit from that. Then maybe we should give a number to put a little bit of formalism around that. So Bob, you did put together the current yield curve.
It was
TIPS.
very, very complicated math. It was addition and subtraction here. So,
but yeah, let's look at the 20-year number from the yield curve you put together, which is pretty current right now.
Yep.
So what's the 20-year Treasury yield?
So this is just for all the compliance folks. This is as of 9/5. So the night before we're recording this, the nominal
5th,
yield on the 20-year Treasury was 4.56. The yield on tips was 2.02. So, the expected inflation over the next 20 years, so, just the annualized rate over the next 20 years is expected to be 2.54%. So 2.5.
So just to level set here to make sure. So if you take the nominal 4.56, subtract out the tips yield, which you can buy and all of that, 2.02, 4.5 minus 2.02 gives you 2.5%, 2.54%. So that's the difference is now. Why would there be a difference? Again, because tips adjust for inflation on a yearly basis. It resets for inflation for you. So the market is not going to give you the nominal 20 plus resetting for inflation. So the market subtracts out the expected inflation to make sure that it's a wash.
Right.
From that vantage
To
point.
be even
Equilibrium.
more direct,
go
it's
on.
not the market doing it. It's investors are looking at this and saying, how much am I willing to pay for that inflation protection? So, this is where we get to that marginal investor idea. The marginal investor is willing to pay up to whatever they think inflation will look like over that 20 years and no more.
And now,
And that's where, if I'm an
Sorry, go
investor
on.
in the bond market wanting to buy a 20-year treasury, this is where the supply and demand comes into play. If I believe as an investor that inflation will be higher than the 2.5%, I'd want to buy tips because I would expect them to then provide a higher yield than treasuries would provide. If I believe inflation's going to be less than 2.5%, I'd want to buy a traditional treasury because I would expect it to provide a higher overall yield over those next 20 years. And there is definitely, it's not just expectations, because there's also the risk component that if I'm trying to fund a spending goal that may rise with inflation, even if I may favor the tips because I want that additional inflation protection, just in case. It's going to be more harmful to the retiree if inflation's higher than they expect than if inflation ends up being lower than they expect, although not necessarily deflation, but lower than the 2.5% break-even rate that's available in the market right now. And I did just pull that 20-year case out at random, but then I realized after doing that, that's the number that gives us the highest. Inflation's expected to be the highest over the next 20 years of any of these. All the rest of the break-even numbers are under 2.5%. They're more in the ballpark of 2.3% for them. Even over the next 30 years, the baked-in inflation rate in the market right now is a 2.28% annualized inflation rate over the next 30 years. So markets are, investors participating in the markets are expecting inflation to be lower than that 3% number we see right now, and lower than the historical average.
Yeah.
Right,
And
Bob?
even going to the other side, the really short term, I mean, we're looking at expected. We know basically it's not going to be this, but this is our best guess of 2.3%. Again, substantially below the historical average, substantially below what we've seen. And again, this is especially where we start getting into politics. Some people are really going to like that idea. Other people are going to, have other stories to tell about that.
Well, the only thing I would add to this is, remember, this is a basket of goods. That's not to say you don't go into the store and see eggs skyrocketing, and then say to yourself, hey, I just heard this podcast, 2.5%. The hell are they talking about? You know what I mean? That kind of thing. You are going to see pockets of things. So no, because I hear this is the dinner table conversation where it's not good enough just to say, oh, eggs are high, so inflation is crazy. That there are exogenous
some
things
prices
that
rise
happen
faster than others.
Yeah.
Well, eggs have started to come back down, but you're absolutely right. I mean, every industry has got its own stuff going on. So there was problems with eggs. It was something with the supply chain. I don't know what it was, but eggs were really expensive for a little while. Now they're coming back down. Next month, it could be, I don't know, yogurt. It could be, cars are really expensive right now. I'm getting met emails from car dealerships asking me to trade in my car now because they want people to come do stuff because prices are really high because the car supply chain is really screwed up right now. But that's always been true. There's always something going on. Something's really cheap, something's really expensive. But inflation is a broad issue, or at least how we really should be thinking about it is a broad issue. What's the whole goods and services that we're buying? What are we actually paying to live rather than each individual item?
All right. So, Bob, what do we do so we laid the groundwork for inflation. Where do we take this on this Retire with Style podcast?
That's right. So, the next question obviously is, okay, inflation exists. What do we do about it? Because as much fun as it is to talk about economic history, that doesn't do much for your retirement plan. So, the next episodes, we want to start digging into, how do we deal with it? How do we build our plan to accommodate the fact that there is inflation? How do we build that so that we can have the life we want without, not running out of money, but not having as much money as we want to spend, having our real purchasing power reduced through time. There's going to be different approaches. We're going to, as you might imagine, you're going to be talking about this in terms of the RISA quadrants, how different people might want to approach that problem.
That's a great angle.
That's great. So that we've got.
I thought you guys might like that one.
Tune in next week. Absolutely. So thanks,
I don't
Bob,
like it,
for
Bob. I
helping
love
us
it.
introduce.
Sorry, wait.
Alex is excited for the next episode.
Yes.
Yeah, we'll continue this series next time on Retire with Style. We'll get deeper into how to manage inflation as part of a retirement income plan. So thanks everyone for listening. Thanks for joining us, Bob. And we'll catch you all next week on Retire with Style.
Thanks, everyone.